tuning in. Thank you for being a part of my first home buyer success webinar. This webinar is designed to educate future home buyers, or even if you already own a home and you just want to refresh your memory of the process and things you need to be aware of. This course is just for that. It's to educate the public on what it takes to actually purchase a home, particularly in Texas, because that's where I'm based, and I'm a realtor and licensed realtor here in Texas. I help sellers, buyers, renters find homes. I primarily work with sellers and buyers, but I happily work with renters as well. I know the market right now is crazy, and so a lot of people are postponing purchasing a home, and that's fair. It's a smart financial decision, especially if you can't put down a really hefty down payment on a home. But this is the perfect time to start educating yourself on what to be prepared for and what to expect when it comes to the home buying process. I am actually on my phone here on a live video on Instagram. So what I'm going to do is I'm going to drop the link for this on my live, just in case someone wants to hop in. They can have that information, because I definitely want to make this available to as many people as possible. It's really just about education. When I first started studying real estate, you learn a lot in school and you don't necessarily use everything that you learn. It's a lot of information that you don't use, but there's a lot of information that you don't learn. So I've learned a lot, and that's why I'm here. I want to share what I've learned and share that with you guys so that you guys are ready and prepared when it comes time to start purchasing a home. Okay, so they're already trying to hurry me up. I didn't even know that was a function. Can I not do a webinar by myself? Okay. So that's not working like I thought it was going to work, but I'll leave it live just in case anyone has questions on Instagram. They see me live. Okay. All right, we're going to go ahead. I'm going to share my screen. You won't see me for a while because I have a lot to share, but I'm going to try to get through it in a timely fashion. And as this is being posted on YouTube, be sure to comment in the comment section if you have questions regarding any of the information that I presented, and I will respond to you as quickly as possible. So let's go ahead and as I've already mentioned, this is Sakeenah Aleem. I'm a realtor with JBGoodwin Realtors, and you are about to participate in my first homebuyer success webinar. Thank you so much for watching the video, and if you have any questions, like I mentioned earlier, please feel free to drop any questions that you have down below in the comments section. All right, so on today's agenda, we're going to discuss a few things. I'm going to tell you a little bit about myself and the brokerage I work for, JBGoodwin Realtors, just a brief introduction, my mission. Then we're going to go to how much home you can afford. We're going to talk about how you know how much home you can afford. We're going to talk about getting pre-qualified. We're going to talk about some lending options. We're going to discuss how much money you actually need to buy a home. We're going to discuss the difference between appraisals and inspections, home inspections. And then we're going to talk about some things that happen from the time you submit an offer until you get to the closing table at the title company. Okay, so why did I choose real estate? I chose real estate because I previously worked in property management. I have 5 years experience in residential property management, and my last job, I was a leasing consultant. I was there for 3 years, and so I have 3 years of property management experience as a leasing consultant. I had a desire to expand my career options and just increase some autonomy over my life, and I wouldn't say create work-life balance, but create a tolerable work environment for myself. And I saw real estate as a way to do that, kind of to expand on what skills I already had, but at the same time learn new skills increase my income depending on how, hard I work and how much energy I put into my business. And then I decided to partner with a successful broker with a proven track record and an awesome training program, and that is JBGoodwin. That is why I decided to go with JB. So my mission is to help people make generational wealth and home ownership possible. As I got into real estate and started noticing, the realities of home ownership, I'm not a homeowner. I don't know what it's like to own a home. My parents are homeowners, and I see everything that they go through and what they've had to go through with their home, and I understand partially, but I've never had that full responsibility. However, this career path has taught me a lot about homeownership that I was not aware of, and I feel like when I do decide to purchase a home, I'll be more than prepared. I mean, even with property management, you learn a lot about maintenance and repairs and things that happen. So there's a lot that I've experienced that allows me to have empathy and understanding for the big decision that people are going to make. And I see real estate as a way to create generational wealth and to create an investment plan for your future, your kids' future, your family's future, whoever you have in your life that you feel is important. So here's a big question. How much home can you afford? So one of the big things that you will hear people talk about if you meet them, they're talking about how much, what kind of home they want. People always have that dream home. They know what style home they want. However, they're not really well versed on the pricing of homes. So you need to know how much home you can afford. And some people, they think, oh, I make this much per year, I can afford this. Well, that's not really the whole picture. Unless you plan to pay for cash for your home, you won't know until you're pre-qualified with a lender exactly how much home you can afford. That is because if you have to finance your home, you're borrowing money. And when you borrow money, there are limits because they're not going to just give you, a lump sum of money without knowing and feeling that you will be able to repay them in the time allotted. And you're not just going to tell them, this is what I want. They're going to look at your credit score. They're going to look at your income. They're going to look at a lot of different factors before deciding how much they're willing to lend you. So, financing options. If you are not paying for a home cash, if you're not a cash buyer, then you're going to need to finance in some form or fashion. And I want to tell you about a few loan types that are available on the marketplace right now. So we have the conventional loans. Conventional loans can be conforming or non-conforming. They typically require higher down payments and credit scores, and they're compared to government-backed loans, and down payments lower than 20% will be required to pay PMI or private mortgage insurance. So conventional loans are common, but there are definitely times when you should use a conventional loan and times when you should try to get a different type of loan, and we'll discuss that later. The next loan type we have is the FHA loan. FHA loans are popular because you don't have to put down a 20% down payment for FHA loans. And most people don't know that. They typically have a lower credit score requirement and down payment requirements, as I just mentioned, and they allow for a higher debt to income ratio than conventional loans. So if you have more debt, then you might want to look into getting qualified for an FHA loan, because a conventional loan, you're going to need to have a lower debt to income ratio, your credit score is going to need to be higher, and you're typically going to pay a higher down payment. So I just got this chart and I just want you to compare the two. So with the conventional mortgages, you can see on the left-hand side and then the FHA loans on the right-hand side. And there's a minimum FICO credit score of 620 for your conventional. And then for your FHA loans, you have a 500 to 580. So that's quite low. Even if you're renting a home nowadays, they want you to have at least a minimum of 620. So that FHA loan is quite lenient. And that is great because it allows people who don't necessarily have the best credit to still become homeowners. With your conventional loans, sometimes you can have your down payment be as low as 3%, but you're going to usually see 5 to 20% is typical. Most people try to aim for that 20% to avoid having to pay PMI insurance, which can be costly. 3 to 5% with a 580 credit score or 10% with a 500 credit score is common for FHA loans. With mortgage insurance, the borrower is going to pay PMI if the down payment is less than 20%, but the insurance can be canceled when the loan to value ratio reaches 80%. Now with FHA loans, the borrower will pay an upfront premium and you're going to make monthly payments, but then there's also, it's similar to PMI, but it's not PMI. But basically it's a premium that they make you pay. Loan limits. So there are loan limits. These are the numbers for 2022 for each of the respective loan types, but these change. So definitely get with a lender to find out exactly what the limit is going to be and what your limit will be, because it really depends on you. Debt to income ratio, typically 36 to 45%, but may stretch to 50%. FHA loans, 50%. Now, if you were wondering whether or not you should do an FHA loan or conventional loan, here's where I'm going to break that down. So an FHA loan is going to make sense if you have less than stellar credit history, if your debt to income ratio is high, if you need a smaller down payment, and if you're purchasing a primary residence. So these are all factors to consider if you're thinking about getting an FHA, or you're wondering if you should do an FHA loan compared to a conventional loan. There are some down payment assistance programs. We're not going to really get into that in this seminar, but if you want to reach out to me directly, you can do so. My email address is Sakeenah@JBGoodwin.com, and I will have it down in the description box as well, my contact information. If you want more information about down payment assistance, I can assist you with that. I've actually helped clients with that, and it worked for them. And their case was very extreme as well. So I got to see, with working with them, I was able to see all of the different ways they were able to finance their dream of owning a home for their family, and all the different tools they were able to utilize that are out there. So don't think there are not ways to get it, because I've seen people do it and I was amazed that it happened. So, and they got their house. So it works. You just got to know the resources and know the rules. So we have a conventional loan. So a conventional loan is going to make sense if you have a credit score of at least 620 or greater, if you think the property won't pass the FHA home appraisal, if you plan on paying a sizable down payment, if you're purchasing a second home, if you plan to own the home for a long time. These are all reasons why a conventional loan would make sense. Next up, we're going to talk about VA loans. VA loans are unique because obviously you have to be a veteran or a surviving spouse of a veteran in order to qualify for these special loans. So a VA loan is a mortgage program that benefits veterans and their surviving spouses purchase and refinance their homes. So typically with the VA loan, there is zero down payment or 0% down. I'm not gonna say typically; it's known. My dad's a veteran; he was in the Navy, and so that's the loan that they use. Use the VA loan to get a 0% down loan to get their home. No private mortgage insurance required, which is great. That's thousands of dollars you're saving. Some of the lowest fixed interest rates. Fixed. So a fixed interest rate means it's not going to fluctuate over time. Now, if you want to know more about that, we are in the perfect storm of an example right now. The Fed just raised the base points another 0.75%, and that's a lot. That's a lot. There's been, I think, five in the first 9 months of the year. So we knew this was coming. They said it was going to come, so it's not too much of a surprise, but it's actually happening. And so we're going to see the effects of that. You'll see that, especially if you hold debt. If you hold debt, that's where it's going to come into play, because those rates are going to cause companies to raise their interest rates to kind of combat the 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 raising of the federal rates. So, for example, if you have a credit card, you normally were paying, I don't know, 0.3% or whatever your interest rate on your credit card is, but it might fluctuate if it's not a fixed rate because of the recent changes by the Fed, and that's going to make your interest rate payments go up. That's for your car, that's for your credit cards, and for your mortgage. So this is great because with the VA loan, you're not going to have to worry about that because you have those fixed interest rates. So veterans, this is still a good time for you to purchase because you're not going to be affected by all of the inflation that's happening and all of the interest rate changes that are happening. So that's one thing to know. And it's also easier for you to qualify for your loans as a veteran. USDA loans, you don't hear too many people talk about them because they're specific. They're offered by the United States Department of Agriculture, the USDA, only available for purchases in rural area as specified by their county. So rural areas would be like, in the Austin area, a rural area would be like Elgin, possibly even Bastrop, just areas that are out of major metroplexes. I think areas of Georgetown might be considered rural, but those smaller towns, Smithville, Katy, McDade, these are little towns. Taylor, Texas will probably even qualify for USDA loans. But 100% financing for qualified buyers. Closing costs can be packaged into the loan or financed by the seller. Must meet county income restrictions. So this is an income restricted loan. And for people who choose to live in rural areas, the loan is only available for owner occupied homes, not investment properties. So if you're an investor, you're thinking about holding investment properties, this is not the loan that's going to work. Now, one thing I want to do in this webinar that I felt was very important is to pull up the loan application worksheet. Stop sharing. And this is important because this was my first time actually seeing this, and this is when I got into the industry. But this pre-application worksheet is super valuable and super important because make sure I'm still sharing my screen, my entire screen. Okay, sorry, I hopped off real quick. Let me share my screen again so you can see this. When I saw this, I was really shocked because I didn't realize how much extra cost, went into purchasing a home. So this is the pre-application worksheet. This is an actual pre-application. So when I say get pre-approved, this is similar to what you will receive. It really depends on the loan originator software they're using, but this is similar to what you will receive. And it'll have your information. Obviously, this doesn't have anyone's personal information on there, but I highlighted things you need to really know about and really focus on. So we have our down payment here. This is a FHA loan that they were applying for. So this is a 3.5% down payment, and there is so that would be $9,625 for the loan amount. And we, for this one, it's just based off of it's just like a dummy house, I guess you could say, like just a practice house, just to get an idea of what their landing would look like. And so we pulled up a house on the MLS and we had them run this report, and it shows, how much they would be financing, which is a 270 here. The appraised value of the home is 275. The loan to value ratio is 96.5%. So as you can see, the loan amount is less than the actual appraised value because you're putting down a down payment. There's an interest rate of 6.125%. It's a fixed amortization, 360 months. Now, these are the other things that you have to consider. So there's other fees associated. So there's a hazard insurance. There's $120 for hazard insurance. Real estate taxes, $440. Mortgage insurance, $186.95. Total monthly payment is $2,387.61. So that is what you would be expected to pay monthly for this house. So when you get pre-qualified, these numbers are not fixed. This is a pre-qualified. This is giving you an idea. And it's also letting you know exactly what you would be qualified for. Now, all these fees, there's an appraisal fee. And this is when the bank, the person who's loaning you the money, they send an appraiser to appraise a house to make sure that the house that you selected is worth the amount that you want to pay for it, because they're not going to give you, a lump sum of money if the house is not worth that, because of, what recently happened, with the Austin market and why it was so crazy. People were paying $10,000, $20,000, sometimes $40,000, $50,000 over asking price, inflating the value of these homes. So in the appraisal world, the home wouldn't be worth that much, but because it was such a high demand to live there and for people to move into the Austin city limits, that's what caused those home values to go up. So the home necessarily wasn't worth that amount, but there's a lot of people paying cash. So if you pay cash, you can pay as much as you want and you don't need a bank, or if you're only financing a small amount, the home will appraise for that amount and you'll pay the rest of the cash. But it's up to you if you decide that you want to spend that much money on a home that isn't really technically valued at that rate. But that's going to cost you $850. The credit report is going to cost you $50. And as you can see, there's all different types of fees associated here. $200 for an appraisal field review fee, a document review fee, lots of different fees. Reserves and escrow. So they hold a certain amount of money in escrow here. And then prepaids. All this is prepaids over here. Title and closing fees. So when you need to get the owner's title insurance, $2,000. Lender's title insurance, $250. And then this is what I like, the very bottom, because it kind of shows everything. On the left hand side, you have the total cost for everything, including all your fees. All fees up here totaled down here. You have $290, $147.73. Remember, this is a house that's valued at $275. Got all the way up to $290 because of the closing costs. That's something I want you to pay attention to. Next, here on the right hand side, you see the loan amount. So we have that $265, and then we have your funding fee, the FHA funding fee. And this is because this is using the VA funding fee. If you're not a veteran, then this won't apply to you, right? But seller pay title. So this is assuming the seller is going to pay the title. We don't know that yet. In this market, yes, you are more than likely able to get a seller to pay the title in your negotiations. But 6 months ago, that wasn't the case. 6 months ago, the market was still a seller's market. Now that homes are sitting on the market a little longer, sellers are offering different concessions at the closing table, and that might be something that they're willing to do. Just pay for that title. They're going to reuse a survey, so that's only $475. Down payment assistance, which I told you about, is $5,400. So if you end up getting down payment assistance, they'll pay a portion of the down payment, and that's what is here on this form there. Now at the bottom, your total credits is $277,794 total. And so what they do basically is they subtract the difference. And so this is what you're expected to pay at the closing table is $12,353.73. Now I want to draw attention to that because remember your down payment was supposed to be $9,625. This person got down payment assistance in the amount of $5,400. And this is the total that they need to bring to the closing table. Now, this is important. I did a video, buyer beware, something that you need to know. I forgot the exact title, but I know that buyers beware what's in the title. And I'll link it above. You can check it out. It'll pop up here in a second. But it talks about needing cash to close because a lot of people think, oh, I saved a down payment, I got my loan, but they don't factor in all these other fees that it costs to close on the home. That's why I wanted to go over this because you're putting in all these extra fees on top of the $9,000 that you had already planned on spending for your down payment, and now you're going to have $12,353.73 total. So that's a couple grand more than what you were expecting to spend. And if you don't have it, well, then guess what? You're not closing. The deal falls through, and you're going to lose your option fee and possibly even your earnest money at that point. We're not going to talk about all the ways that you can back out of a contract because there are several ways. There are several opportunities to back out of a contract, during the contract period without, losing more than just your option fee. But if you work with me individually as my client, I'm going to walk you through the 1 to 4 form, which is the form that you fill out whenever you're submitting an offer, the 1 to 4 family form. I'm going to walk you through that, and I'm going to show you all the different areas that state, you can cancel this contract and they would have to refund you your earnest money. Your option fee, you don't get that, but your earnest money, you can get that refunded. And there are at least 5. I was studying that contract a week ago, and I was just highlighting and writing down every single time it said that you can get your money back. And there's quite a few. I'll mention a couple here in this seminar or webinar, but I'm not going to go through all of them. But if you ever want a one-on-one with me, if you're thinking about purchasing a home and you want to discuss it, please reach out to me. Send me an email, Sakeenah@JBGoodwin.com, and I will happily, schedule a consultation with you, and we can kind of go over your home goals. I can connect you with lenders that can get you pre-qualified. It does not cost anything to get pre-qualified. That's another thing. They are going to do a soft credit pull. They're going to pull your credit. So be aware of that, but just so they can get an idea of what you're working with. And then once you decide you're actually going to submit an offer and go through with it and need the loan, that's when they actually do the actual full loan application with all the information you've already given them. And that's when you would then be required to pay that fee. So your earnest money, which is something that you put up at the time of your offer being accepted. So once your offer is accepted, your contract is countersigned. That is when your contract is considered executed. And you have usually a 5-day window to get the money to the title company, your earnest fee. And if you're planning on doing option, if the option period was included on your contract, then you will need to also have that money given to the title company. They hold that in escrow, and it will go towards your closing costs. If for some reason you back out of your contract at any time and it's not within one of the specified periods in the contract where you would get a refund or reimbursed, or I shouldn't say reimbursed, but you should get your money back for your earnest, then you lose both fees. The option fee is never refundable. But that earnest money, that is refundable. And you're probably wondering, how much is that? Well, we'll get into that in a second. I'm going to pull back up my slideshow and show you that in a second. But Option fee is never refundable. Earnest money is refundable. And I should have had a residential for contract ready and that on the screen as well. But I don't want to actually go through that form completely. If you work with me one-on-one, we will sit down and we will go through that contract line by line so you understand it. So that whenever it comes time to submit your offers, you understand what's being sent out. But let me just pull this up. Buyer's representation. So there are different forms, like you can withdraw your offer, amendments. If I can pull it up quite easily. I can't find it. I mean, I know where it's at. It's gonna take me a while to get to it. I don't really want to prolong this longer than it needs to be. So let's go ahead and move on to our next. I'm gonna share my screen again here. And we're gonna go back to our slideshow. I just wanna go over some important terms with you. All right, terms to know. So you have your hazard insurance. So these are terms and things that you might have seen on that loan form that I just showed you and shared with you, that loan application. So hazard insurance is usually required for a mortgage and provides protection in case of a natural disaster or other hazards. Mortgage insurance protects the lender in case the homeowner defaults on their home loan. That's PMI. PMI is private mortgage insurance. Amortization. It's a payment schedule for the payment of your loan. You typically pay more toward your interest, and then as you continue to pay as time goes on, your interest payments go lower, and the payments that you're making or the amount of money that's actually going towards your house increases. Loan to value ratio. The amount of the mortgage compared with the value of the property. Now, so say you put an offer in on a home, right? So we're at that point. You found a home. We went out, we looked at a couple homes, you found the one you liked, and you decided you wanted to put in an offer on that home. Now your offer was accepted. Now the offer is accepted, I have to get that money to the title company. So I have that deadline. I got to get that money to the title company so that everything is copacetic. And now the bank is saying, okay, we're gonna start the appraisal process just to make sure that the house that you selected is actually worth what you're trying to purchase it for, or worth what you want us to loan you the money for. So once you've chosen a home and submitted an offer, the lender will want to inspect this home to see if it's worth the amount they're lending you the money for. The appraisal is important because this is one of the things that could actually kill the deal. Nice home, huh? Now this is actually a snippet from, let's see if I can move this. Yes, I can. This is a snippet from the 1-to-4 contract. It says the lender required repairs and treatments. Unless otherwise agreed in writing, neither party is obligated to pay for lender required repairs, which includes treatment for wood destroying insects. If the party do not agree to pay for the lender required repairs or treatments, this contract will terminate and the earnest money will be refunded to the buyer. So the lender comes back and says, hey, so we think that this needs to be repaired. So it's not only just appraising it for the value of the home, they actually want to make sure the home is livable and that it's up to code. And there might be some things that the appraiser finds and says, hey, this needs to be fixed before we will agree to, or the appraiser is going to communicate with the lender, because the appraiser is actually hired by the lender. The appraiser is not hired by you, the buyer. The appraiser is hired by the lender, so they are under the jurisdiction of the lender. So they're going to tell the lender, hey, this house needs this kind of work because, a year from now, this could break down and this is not safe or something like that. So they're going to come back with the appraisal to the lender, and they're going to suggest some things that might need to be repaired. Now, the lender is going to have, and this is not all situations, but this is just a scenario that could happen. If the lender says, okay, these things were recommended that they get repaired, so this needs to be repaired. And it's up to you, the buyer, and the owner to decide who's going to pay for that. Y'all are going to have to negotiate that. Neither one of you are obligated to pay for the repairs, but somebody has to do it, or the deal falls through, like the deal is off. So if neither party does not agree to pay for the lender required repairs or treatments, this contract will terminate and the earnest money will be refunded to the buyer. So if y'all can't come to an agreement on who's going to pay, and you decide that you're willing to back out of this agreement to buy this home because of it, then you will be refunded your earnest money as the buyer. You will lose your option fee because that's never refundable, but your earnest money, you will definitely lose that. You will get that refunded. If the cost of a lender required repair and treatment exceeds 5% of the sales price, the buyer may terminate this contract and the earnest money will be refunded to the buyer. So let's take this $275,000 house that was on our loan application. Let's multiply that by 0.05. You get $13,750. So if the repairs on this house exceed $13,750 in this example, the buyer has the option to terminate the contract and the earnest money will be refunded. So there's two ways and instances under this particular section of the contract where you can actually terminate. If neither of you decide to pay for the fees, or if the treatments and the fees exceed 5% of the sales price. So maybe you decided that you would pay, but then once you found out the amount that it was going to cost, and found out it was 5%, you decided, nah, I don't want to pay that additional $13,000 just to get this house. And remember, that's on top of your closing fees that are already close to $13,000. So that's $26,000 out of pocket at the end of the month. It usually takes about 30 days for these contracts to close, that you have to, fork up. And this is just this one scenario. Let's say you put down a 20% down payment on a house. That's more than the $12,000 we were talking about, or the $9,000 we were talking about. So you really want to make sure you know this information up front, because you want to have this money ready should you need it. Home inspection is up next. So the difference between a home inspection and an appraisal is the home inspection is optional. The appraiser is hired by the bank because it's in their best interest to make sure that the money they're lending you is for a house that's worth the money. Now, if you decide that you want to have the home inspected to make sure that, there's nothing that's going to need a repair within the next year, or if there is, you're aware of it so that you can prepare financially, then this is what the home inspection is. And it is done during what is called the option period. I recommend that all people get a home inspection because it has been said that, 2/3 of homeowners who purchase a house are usually going to spend at least $1,000 in some type of repair within the first year of owning the home. So you want to make sure that you know what you're getting into. Home inspections, they range in price, but it can be anywhere from like $300 to $500. So that's another expense that you will need to account for on your own. This is not something that you're putting up in your closing costs. No, this is outside of your closing costs. So be prepared to pay that. You have to actually pay for an option period. So that's something that you need to consider as well. And your option fee is non-refundable. We mentioned that. And it's typically about 0.1% of the purchase price, but that is negotiable. So if the price of the house is $275 times 0.01, so 0.1% will be 0.001, so 275 times 0.001. You're looking at about $275 for a $275,000 house for your option fee. This money goes either towards your closing costs, or if you decide to back out during the option period, which is negotiable, but typically it's about 5 days, 5 to 7 days. Is a typical option period. You want time to get the inspector in there. They can usually get you in a report within 24 hours. However, you want to go over the report and make sure that you have time to figure out what repairs you want to negotiate, if you decide to negotiate any repairs. So you need a couple days to decide that as well, but you don't want to be too pressed for time. So the option period is a paid and negotiated period of time where a buyer can have the home inspected and terminate the contract for any reason. So within this 5 to 7 day window, whatever window you negotiate with the seller, within that window, you are going to have the option to terminate. If you decide to terminate, you will be refunded your earnest money, but you will lose your option fee. And in that instance, the option fee goes directly to the seller. They pocket that money. So that's the difference between a home inspection and a home appraisal. The appraisal is for the bank, the home inspection is for you. And now this is what I quoted a minute ago. Hippo is a home insurance company, and on their website I was reading, they said roughly 2/3 of homeowners that they polled had to fix an unexpected issue in the first year of living in their new house. They said they spent more than $1,000. So that's another amount, that you're going to need to set aside to worry about. We always recommend that you also get a home warranty package. When you purchase your home, the home warranty package is going to ensure different things such as appliances, because those are things that regularly break down. And working in the apartment industry, I saw that regularly. I worked in brand new apartments, freshly built, and we had new refrigerators going out. We had new microwaves not working. So a lot of the quality of some of the appliances, they don't hold up and things happen. So you want a home warranty, because that home warranty is going to help ensure that. So if you need to get things repaired, you can call on that home warranty that you're paying, that you paid for, and it'll cover the repair, as opposed to having to go out and hire a repairman. They'll hire a repairman. They have their own repairman they'll send out, and they'll do the work. And it's covered under the warranty if you get a warranty, but that's what I'm just letting you know. So getting to the closing table. So man, we just went through a lot. We put down an offer. We paid our fees to the title company. The home got appraised and it was approved. You didn't have to do any repairs. Thank God. And then you got the home inspected for yourself. You saw a few things on there that you thought, would be concerning in the next few years. And in the report that the home inspector is going to give you, it's going to have things tiered. I've seen one before, and typically they highlight the most important things in a certain color so that you know what's most important. And then they'll just highlight smaller things and let you know, you might want to check this out in a couple of years, or this might be something that you need to worry about 5 years from now, or just keep an eye on it. They'll let you know, kind of like when you go get the oil in your car changed. A lot of times if you go to a dealership, they'll tell you, everything else that's wrong with your car that you should consider, or just routine maintenance that you should consider getting done. That's kind of what the inspection report is going to be like. Now, whenever you are about to close, this is some things that you should know. Don't pull money from random sources, because the loan officer, they're going to want to know where this money is coming from because they want to make sure it's legal. So make sure you're telling them and you're honest about your income. Like if you're making money from certain side jobs, be forthcoming with it and have paperwork to back it up, because if you try to bring them cash from an undisclosed source, it's gonna raise some red flags for them. In some instances, you are allowed to have family members supply you with money. In some instances, you're able to have family members gift you money, but that is certain instances, and I would definitely speak with a loan officer to kind of make sure you know what that is, which loans it works for, and the amount. Make sure your funds to close on your home are accounted for in your bank account. So if you know you're going to be purchasing a home in the next 6 months, make sure all the money you plan to use to close on the home is in your bank account, so that whenever you go to get pre-qualified or pre-approved, they can see that money, so that there's no money, just appearing all of a sudden. It needs to be in your account at least 90 days before making an offer on a home. So usually that's plenty of time, because you're probably not going to get pre-approved until, maybe 60 days before you get a home, or I don't know. Just make sure that the money is in your bank account and accounted for. And they want to make sure this money is legal. So let's make a paper trail for them and get to the closing table without any problems. Lastly, I'll end on this note. Typically, funds are processed at the closing table, and that is usually when you get possession of the home. It's going to depend on your contract. You write in the date of possession, but typically it is at closing, at funding. It's when you become the homeowner, you receive the keys, and it's all yours. All right, that is it for my presentation. Oh, no, no, no. There's one more slide. I totally slipped, guys. There's one more slide. Let me pull that up real quick. This is the last slide. I thought I was done, but I wasn't. So getting to the closing table. So your option fee and your earnest money go towards your closing costs. I think I discussed that already, but I kind of want to reiterate that the money you're giving at the beginning when you first have your contract accepted and executed, that money is going towards your closing costs. Closing on a home usually takes about 30 days. If you are getting financial help, if you're getting, if you're taking out a loan, it could be as short as 10 to 15 days if you're fully cash funded, because it really depends on that buyer. If you're buying with cash, you don't have to do an option period. If you choose to waive your option period, that shortens the time. So it really just depends on your funding, how long it's going to take to close. Always check with your lender if you are, financing. Always check with your lender on a proposed closing date, because things can happen and it might end up having to push the closing date back during the entire closing process. They're trying to get their paperwork in the order and the numbers in order, and so sometimes it might get pushed back a couple of days. I've seen that happen. So always check with your lender on the proposed close date, so that the seller and you can kind of all be updated and aware of what's going on. Obviously, if you're working with a realtor like me, I'll be in the loop as well, so we'll all be notified and on the same page. That is the last slide there, and I'm going to stop sharing, come back to me. All right, guys, so that is it. I was able to get that all into 1 hour. I kind of strung it along just a little bit as well, but I hope that this webinar was of value to you. If I made any errors in there, any, fact check me, please do. I definitely have no issues being corrected, but I'm pretty sure everything in there is pretty good. There was one thing in there that I think I might have misquoted, and that was the number of days you have to get the money to the title agency. I'll need to double check the contract, but it's either 3 days or 5 days, and there's like a time stipulation, like you have to get it to them by, I think, like 5 p.m. It has to be on a business day, like Saturdays and Sundays don't count. So all of that is factored in, but I will drop the corrected information if it was incorrect in the video in the description box below. Thank you so much for tuning in and watching the video. I really appreciate it, and I plan on doing a webinar live every quarter. So this is my third quarter webinar. I will do one next quarter as well. I won't film it, but I'll have it ready. This will be the only one that I filmed because I wanted to post this up on my YouTube channel um, in case people just want to watch it at their leisure, and I can send it out to people who might be interested in viewing it as well. But thank you so much for watching. If you have any questions, don't hesitate to drop them in the comments section. Don't hesitate to reach out via email. I'm happy to answer any questions you might have. I did it, guys. That was it. I look forward to working with you, and I look forward to hearing success stories in your home ownership journey. Have a wonderful day. Goodbye.